How's it going, everyone? This is Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. I'm really looking forward to getting some of this great content to our listeners because when I originally started compiling the list of these potential guests, I realized this is not only going to be very beneficial to our listeners, but it's going to be a tremendous learning experience for me because I get to ask the type of questions that I really want the answers to. You see, there's a lot of podcasts out there that help people who are just getting started, people who are just considering and investing in real estate for the first time, and those are all great. But I really want to provide some content that even extremely experienced real estate professionals will be interested in. So because of this, we have a lot of guests that are set to come on the show that are absolutely titans in the industry. People that have done hundreds of millions of dollars of transactions, people that have millions of square feet under management, stuff like that. And because of that, I'm not going to be doing a lot of the talking. I know some of you are jumping for joy at that realization. So I wanted to give you a little bit about my background so you know my perspective as an investor. I've been a full-time investor since 2010, and I'm currently invested in about 35 syndicated opportunities that have a combined asset value of more than $350 million. In conjunction with these investments, I've invested in virtually every type of real estate transaction that exists, and the focus has really been on mobile home parks and self-storage facilities, but I've also invested in residential mortgage notes, single-family houses, multifamily apartments, financing, and also non-performing notes. Now, it's important to remember, though, that a lot of these investments are passive investments, and the distinction between passive and active is very critical. Usually when someone specializes in one type of real estate, they become over-allocated to that type of asset class. For instance, if you live in Oklahoma City and you only invest in retail shopping centers within a 3-hour drive or something like that, you're going to be overexposed to that area in terms of economic fluctuations or natural disasters or even state-specific regulations. So what I like to do is find someone who is best in class in the retail shopping center's asset class and invest with them while deferring to their expertise. This strategy has a lot of benefits. First of all, I'm leveraging other people's time and expertise in something that I am not an expert in. See, I may have invested passively in several different retail shopping centers, but my experience may pale in comparison to families or businesses that have spent the last 30 or 40 years hyper-specializing in one particular asset class or one particular geographic location. So when I invest passively, I get to reap the benefits of their expertise, but I don't have to be hyper-specialized. Another one of the benefits of being a passive investor is you're not exposed to credit or liability risk. A lot of the times, banks require someone personally guarantee these multi-million-dollar loans. And as a passive investor, you're not involved in that process at all, nor are you involved in the liability that goes along with investing in commercial real estate because you're investing in passive shares of an LLC. Typically, those aren't associated with decision-making processes, so therefore you're not exposing yourself to lawsuits. Also, and this is really important, when something goes wrong on the property, let's say a toilet breaks or there's even a termite problem or something like that, the property manager may call the sponsor, who is the person I invested with, but the sponsor will never call me, the passive investor. This way, I get to spend my time doing things I love, building my business, looking for new opportunities, talking to investors, conducting podcasts, stuff like that, rather than dealing with the day-to-day management of any investment. So this suits my personality much more because I'm willing to give up control for the diversification. So I don't have as much control as I would as an active investor, but I'm able to be very diversified. And the reason for this, the reason this is important to me is that that is much more in line with my overall financial goals. My number one financial goal is to be as diversified as possible so that I can sleep at night knowing I'm well protected. The way that I do this is focus on multiple different asset classes, multiple different geographic locations, and also invest in different type of real estate investments that are going to perform during different stages of the economic cycle. This is one of the reasons why I focus on recession-resistant assets. I really like these low-risk investments because it's been proven over and over again that real estate can be a tremendous tool to generate wealth as long as you can protect yourself from economic downturns. So because of this, I focus on these type of asset classes because they are more reliable and dependable. And more importantly, you don't have to deal with some of the headaches that come along with investing in asset classes that only do well when the economy is booming or the capital markets are very loose. You see, generally speaking, every type of real estate transaction is going to do very well when the economy is booming, but there's only certain types of investments that perform during all stages of the economic cycle. And I'll give you two examples. The most important example, the most obvious example is mobile home parks. There is basically an inverse correlation of how well the economy does and how much demand there is for affordable housing. Now, before you say that sounds like a total nightmare, hear me out. First of all, 20 million people live in mobile home parks in the US. 20 million. There is absolutely no shortage of demand for this product. Also, you combine this with the fact that there are 10,000 people hitting the age of retirement every single day in the US. These individuals have very little savings on average. A lot of them are dependent on Social Security. The problem is the average 2-bedroom or 3-bedroom apartment in the US rents for somewhere between $1,200 and $1,300 a month. And the average Social Security check is about $1,200 to $1,300 a month. What does this mean? There's a tremendous demand for affordable housing. And then you compound this with the fact that it's extremely difficult to build new mobile home parks. The vast majority of the mobile home parks in the US were built in the 60s and the 70s as a result of a veterans housing program. Since then, the connotation of what it's like to own a mobile home park or live near a mobile home park has changed significantly. So you have this ever-increasing amount of demand for affordable housing compounded with this decreasing or at least stagnating amount of supply. It sets the stage for a very solid investment. Plus, currently, 51% of the workers in the US are making less than $30,000 a year before taxes. 51%. 38% of the workers in the US are making less than $20,000 a year. So there is absolutely no shortage of demand for affordable housing in the US. So what happens when there's a recession? Well, there is an increased amount of demand for affordable housing. And when people lose higher paying jobs when recessions happen, they are replaced by lower paying jobs, which forces more people into affordable housing. So that is a great example of a recession-resistant asset. Another example is self-storage. Now, self-storage is similar to mobile home parks in some ways and very different in other ways. In case you haven't realized it yet, the US is a consumer-based economy. About 70% of GDP is made up by consumer spending. And once people buy products, particularly non-perishable goods, they don't want to get rid of them. So because of this, self-storage has become a more and more popular asset class over the last 30 years or so. However, the time in someone's life where they're most likely to need self-storage is when they're going through some kind of transitional period. Many of these transitional periods can be brought on by recessions. So for example, foreclosures, job changes, downsizing, kids moving home from college, all of these are more common during recessions, and all of these changes make people more likely to utilize self-storage. Not only this, once a tenant moves in, it's relatively easy to aggressively increase rents because the gross amount of dollars it takes to move to a different facility is much larger than the rental increase. So for example, let's say you're renting a 10 by 10 climate-controlled unit for about $125 a month. If there's a 6% rental increase, the rent would go from $125 a month to $132 a month. So then the question becomes, are you going to take the day off work, hire movers, rent a rental truck just to drive down the road where they're probably doing the same thing anyway, only for $7 a month? Overwhelmingly, we have seen that the answer is no. Of course, this $7 a month may not seem like a lot to a typical tenant, but as an investor, a 6% rental increase is very lucrative from an ROI perspective. This is pretty much unheard of in a more traditional asset class, something like multifamily, for example. And the data lines up with our expectations. So during both 2008 and 2009, over the country, self-storage facilities were able to increase rents during the recession. So the data lines up perfectly with our expectations. Now, keep in mind, this is a relatively new asset class. Investing in self-storage wasn't really popular until the 80s or 90s, so there's still a potential amount of growth there. However, it is massive, and there's a massive opportunity there. To put it in perspective, there are 53,000 self-storage facilities in the US. That is about the same number as all of the McDonald's, all the Starbucks, all the Subways combined. It's a massive asset class with a lot of potential, but you're still getting protected from the downside risk because it's a recession-resistant asset. So I really think it's a tremendous investment opportunity. Now, those are just two of my favorite asset classes, but more importantly, you can probably get a feel for some of the ways that I like to look at analyzing investment opportunities. But I want to make this next part very clear. Just because the macroeconomics seem to be very favorable for certain asset classes doesn't mean all investments are going to be profitable. More importantly, all the really scary competitors out there, the sponsors, the private equity guys, the hedge fund guys out there, they're all privy to a lot of this information. So then the question becomes, how do we know when we're getting a really good investment opportunity? How can we tell when we're making a bet on the right sponsor? How do we know when some of the underwriting assumptions are too aggressive? Basically, how can we stay ahead of the masses in our pursuit for reliable passive cash flow? This is exactly the type of content we're going to be covering on this podcast. So if you're interested in hearing more, make sure to subscribe on iTunes, Stitcher, or SoundCloud at Cashflow Connections Real Estate Podcast. And I look forward to investing with you. Thanks a lot.